years. Anuj Kumar is Managing Director, Chief Executive Officer at CAMS, and he's joining us right now to take some questions. Anuj, good to have you with us here. Good morning. Thanks very much. Prashant this side. I want to start with, the latest in terms of proposed regulations by SEBI, and I'm referring to SEBI rules on total expense ratio. SEBI wants to, SEBI is saying to mutual funds, total should mean total. Nothing outside of the TER, everything should be within, although they are allowing the total expense ratio to go up a little bit as compared to the cap earlier. Could you tell us if this is, the feedback process for this has been extended? I think the last date for getting feedback is this year. If these rules, like how they've been proposed, were to go through, what is the impact for CAMS going to be in terms of profitability, sir?
Hey, morning, Prashant, and thanks for having me over on the show. The proposed new regulations are now open for public feedback. The last date is within the week for public feedback to come in. Essentially, it works the way you're talking about from what I would say reasonably well benchmarked in terms of global positioning that the Indian mutual fund charges represent to the consumer. The proposal is to bring in elements like, brokerage paid on trading of stocks, components like GST inside the TER. There is obviously also a proposed expansion in the overall TER. Now, when you see overall TERs and net income books of AMCs, which let's say operate at 50 or 60 bips, or sometimes a little more, a little less, RTA charges are a small component. They're close to about 5 to 6% of this entire spread. And we believe we sell just enormous value managing all of the liability side operations work for the Indian mutual fund industry. Also, the fact that a telescopic pricing makes our service offering cheaper almost every successive year. So that's the position we are in. We sell enduring value. We sell it at increasingly competitive prices year on year.
Mr. Kumar, both those points are absolutely, and I don't think there's you're the market leader by far in the space. So there's no doubt about that, the value that you bring to the table. But at the end of the day, if mutual funds will have to take a hit, this will be passed along downstream. So could you tell us at this stage, and I'm sure that you've discussed this internally, what kind of impact will this have on your business, sir? I mean, if you could give us some numbers, the way to think about this.
We are not looking at this having a meaningful impact on our numbers. So take that as the baseline. We sit in the same arena. So amongst the large participants, both distributors and us, banks, payment gateways, etc., are large service providers. We are sure the mutual funds would like to have a conversation with us, but it could have maybe a 3, 4, 5% impact, but nothing which is completely unforeseen.
3, 4, 5, up to 5% impact in terms of earnings?
In terms of revenue, yeah, absolute revenue.
Absolute revenue, okay.
Okay. Mr. Kumar, good morning. So can you just tell us, what is the outlook in FY24 in the non-MF business? I mean, just trying to understand, I think the share of your non-MF business is expected to increase from 10 to 15% within the next 3 to 5 years. Is that a reasonable estimate? And what could the plan look like in the next 1 to 2 years?
So if you see, we closed last year at 10% contribution from non-MF. We're expecting that to be about 11.5% this year on a static apples to apples basis. The acquisition of Think Analytics adds about 3%. So we're expecting to close this year at 14%. FY24 should close at about 14% non-MF contribution. Now, from there, our stated position is this will grow to 20%. So my guess is about 1.5%, 2% every successive year in FY25, 26, and 27.
Okay, so from 14%, it will grow about 1.5% every successful year, right? From FY24. FY25, correct. Sorry. Okay.
That's correct. So
got that.
To get to about 20% in FY27.
20% by FY27 from 11% currently in the non-MF business. But what are the segments that you're betting on to reach that level of 20% contribution in the non-MF business itself?
So alternatives, as we've spoken in the past, have grown upwards of 20% last 2 years, should stay there in excess of 20% this year. So that will be one large contributor. Payments, Insurance is doing well, but its success is predicated on this compulsory non-dematerialization coming in a meaningful way. So it'll be predicated on that. And then account aggregator and analytics. So you can think of those five. Obviously, everything will not kind of scale meaningfully every year, but those are the five focus businesses on the non-mutual fund side.
Okay. One final question then, Mr. Kumar. You're sitting on a base of almost 1,000 crores of revenues by the end of FY23. What can you do by the end of FY24? And on a compounded basis, what are we looking at in terms of growth for the business?
Our business depends upon expansion in mutual fund AUMs. Last year was a muted year. AUMs expanded about 7%. This year, the first 2 months have been very good. What happened in the debt franchise in March, April, May, and some of the SIP flows, etc., my guess is we will close the first quarter at upwards of sequential 5% asset growth. So a double-digit asset growth during the year does look possible. And therefore, I think our best case would be about a 10% revenue growth. Of course, we are going through structural changes in terms of TER resets, etc., for the industry. But I think it is possible to see a double-digit revenue growth during the year.
Okay, all right, Mr. Kumar. Thanks so much for stopping by and filling us in with your views. Wishing you all the best for FY24. Well,